Investors. Today we are talking about FIGS. They are a newer company. They IPO'd back in May of 2021. They primarily sell scrubs and healthcare apparel, and were able to capitalize on business generating during the COVID pandemic and the need for healthcare apparel. If you're primarily interested in more qualitative analysis, not so much the numbers and the quantitative stuff, definitely skip towards the end of this video where I'll be discussing that. But I'm going to dive right into the numbers here. Over the last 3 years or so, they have lost about 36% in terms of their price. Now, that doesn't necessarily mean that the company has got 35% worse, and we're going to dive into that a little bit and see what that means. So as far as their ISS governance scores, not great numbers there. Shareholder rights sitting at a 10, so 1 to 10, 10 being the worst. But a big part of that is that there are two primary shareholders that have control over most of the company. So that's probably why those numbers are really high. Profit margin, operating margin, assets, equity, pretty normal numbers there. Negative cash flow, but we'll dig into that a little bit. But 85% projected growth over the next 5 years is good. Really high price earnings, past and forward, but might be justified on that. Price to book's about 3.75, a little high, but not bad for a growing company. Price to sales, 2.57. Really the highest I like to see is 2.5, so not terrible there either. They don't pay a dividend and probably won't for a while. And then really high insider ownership, again, about 20% owned by the two founders. And then really high cash compared to debt. Almost 10 times as much cash as they have total debt in the company. So that's a good place to be at, and part of what kind of got me interested in looking more into this company. So kind of digging into the financials, as you can see here, I look at three big sections. So working capital, obviously cash being the lifeblood of the company. Do they have enough money to pay their bills? That's kind of the big question there in working capital. Capitalization, looking at, okay, how is the company funded? Is it debt? Is it equity? How much assets are they holding? And then, of course, profitability, looking at the nitty gritty of, how good of a company is this? And so we're going to dig into those three parts here. So, of course, we start with current ratio. We want to see how much cash there is, current assets compared to current liabilities. You obviously want to see greater than 2, but 2.5 is kind of my benchmark. And it's nice to see that it's steadily growing. So we start about 2.7 in 2019. Of course, the company has only been public for a couple years now. And so luckily Seeking Alpha is able to have some data going back to 2019 for us. And it's increased by 25% over the last 4 years. So definitely positive there. And of course, we definitely want to check and make sure, okay, are they taking on a lot of extra debt? And that's where the extra cash is coming from. Sometimes if you just look at one ratio or a couple ratios, you can kind of get tricked a little bit. So we want to make sure that there's no, sneaky accounting going on here. Cash generating power ratio. This is one of my more favorite ratios. It's a little newer to me, but definitely interesting to see. So this looks at the cash flow statement and tries to determine, okay, how much cash is coming in just from operations, not from financing or investing. We want to see if the company can fund itself just by, doing regular business. So, of course, you want to see 100%, but more than anything, you want to see it steadily increasing over time. And so here we have a 31% increase over the last 4 years. You have a really big dip in 2021 around the time it IPO'd. And the interesting thing there that I noticed in the cash flow is that they took in a lot more inventory in 2021, and that's what dampened the cash from operations. So if you factored that in, it's actually about close to 90% as well. So nice positive numbers there, but definitely something to see. When you see a number kind of shift, you want to see, okay, what's the reason for that? And so here it had to do with inventory levels. Of course, you had the big shipping conundrums that were going on the last couple of years, and so that's probably part of what contributed to that. Of course, quick ratio for a company like this, where they functionally, live off of their inventory and being able to move it, we want to see a good quick ratio. That's where you do your current ratio, but take out your inventory. So you want to see at least a 1, but you want to see it increasing. And again, we have 12.5% increase over the last 4 years. Very good place to be there. Inventory turnover and days inventory. This gives us an idea of how quickly they can move the inventory. It's really important, again, for a company like this. We looked at Nike, and they were struggling with their turnover over the last few months, last couple quarters. And so a lot of people were trying to look at that to see, okay, are they improving? Are they getting rid of, the inventory glut? So that's definitely something we want to see with FIGS as well. Of course, the numbers aren't great, pretty low, actually, but, and high on days inventory, the amount of time it's sitting there. But it's decreasing, it's increasing, so not great there. We really want to see them pushing a little harder to get that inventory out, and we'll talk about, maybe why that is the case here in a minute. Of course, operating cash flow ratio, this is a similar one that utilizes the cash flow statement. You take cash from operations, divide it by your current liabilities, and we want to see that the amount of cash they're bringing in just from operating is enough to cover all of their current liabilities. Again, that tells us whether they have to take in money from other sources or not. And it's really steadily increased over time, 36% over the last 4 years. Definitely in a great place, past 100% there in 2022. As far as capitalization, how the company's funded, debt to equity, you look at the first 3 years there, they had zero debt at all. And then, of course, in 2022, they brought in a little bit of debt, $19.2 million. Not bad at all. And so very low debt to equity ratio, which is great. Same thing with debt to assets, barely any. And then assets to equity, we want to see, you may feel like, okay, is asset to equity redundant if you have debt to equity, debt to assets? But debt is, actual debt and anything that's categorized as debt, but it doesn't always cover total liabilities. So that's why I do assets to equity, to look at, okay, what percentage of assets are equity compared to all total liabilities. So, of course, we want to see, 50% decreasing, and so we see a slight decrease over time, about 5%. So moving in the right direction there. Tangible book value per share, we want to see that moving and increasing. And, it's a little bit at a time, 25 cents, 63 cents, but it moves up about 65% over the last 4 years. So that's a great increase there. That tells us, if something was wrong with the company and they had to liquidate, that there's actually cash there. And that's a bigger thing for a company like this, where it has physical assets, not so much like a tech company that's focused more on software and those kinds of things. As far as total debt, again, $0 for the first 3 years, and then took in a little bit in 2022. Again, fine place to be at, if you ask me. So that's part of why their current ratio probably popped up to about 6, a 6.3 or whatever. But, increasing a little bit, but not totally concerning there. And then capital expenditures, slight increase by 2.5%. So not burning themselves out. Probably want to see them continue to slightly increase that over time. Now, as far as profitability, their earnings per share hasn't been great. A decrease from 2020 to 2022. However, this is one of those things, an early company coming in, a lot of them don't have positive earnings per share for multiple years. So the fact that they're already coming out swinging, they've got positive numbers, we just want to see that increasing. So over the next couple of years, we want to see, going from 11 cents at least to 12 cents, if not, we want to pass 30 cents there, and just keep topping that year after year, especially as a new company. Now, as far as revenues, we see that they've increased those by 46% over the last 4 years. So big deal there. Of course, gross profits only increased by 45%. So that means their expenses are going up. But again, not concerning there so much. Again, it's increasing. That's what we want to see. Operating margin, there's been some decreases from 2020 to 2022. But again, that has to do with cost of goods sold and some of those operating expenses. And let's see, return on assets, return on equity, both have pretty big decreases over the last 3 years. But I'm not totally concerned. Again, 2020, still pretty much a private company. And then moving into 2021, really getting out there with with the big sharks, the big companies. And so, we're hoping to see that increase over time, but something to definitely watch there. You want to see them getting better returns on their investments. Now, not a lot of noteworthy stuff, but I did read through the 10K, and this is where that all comes from. So I wanted to look at their business model, where their money comes from, and then try to find any red flags. So the first thing that stuck out to me was this statement here. They said they generally utilize shallow initial buys and data-driven repurchasing decisions to test new products. So they don't stretch themselves too thin. They don't go all in on one thing and then end up with the inventory glut. So any inventory that's sitting in there isn't because of, bad decisions necessarily. And then, of course, due to largely non-discretionary, replenishment-driven nature of scrubwear, we maintain less in inventory risk due to a relatively high volume of repeat purchases and focus on our core scrubs offerings. So, that's the nice thing about a business like this. Nurses, medical professionals, they all need scrubs. They constantly need them. They get dirty. They wear out quickly because it's a very on your feet type of job. And so there's constantly a market for it. And, of course, this next statement, I think, is what made this company so unique, is that, they said we branded a previously unbranded industry and decommoditized a previously commoditized product. So I think what was so unique about FIGS is I had really never, thought of scrubs as, something that people really would be interested in, or something that, would be, a fashion statement, so to speak. But I was actually flipping clothes a while back, making some extra cash that way. And one of my friends, they're a physical therapist assistant, and they were like, oh man, I love FIGS. And I was like, I don't know what FIGS are. But I found a pair, and I was so surprised at the difference in the quality and the way that the not just the fabric, but also the cuts and everything else on them, totally different from what you normally picture with scrubs. So definitely took what was a very boring industry and added something to it, and that's part of what drives their sales. Of course, healthcare apparel industry, it's non-discretionary, it's growing, it's lacked innovation, and it's fundamentally changing over time. So again, stepping in and creating innovation where there was none. They're focused on a digital native-based direct-to-consumer business model. They use have a heavy use of data analytics. So another thing that's unique about them is really trying to have the one-on-one relationship with the customers. This didn't work so much for Nike. If you check that video out, I talk about that a little bit. And one of the challenges for apparel companies, they want that direct-to-consumer model, and it doesn't always work, but it has worked very well for this company. And of course, their primary competition is wholesalers, aggregate retailers, and some new entrants. So Fabletics is an example. They were kind of the early entrant into kind of the fashion scrubs model. And so there's others starting to come in, and it just depends on how well they can maintain their competitive advantage and the ability to be synonymous with healthcare apparel. Now, they note that their inventory grew due to the supply chain flowing again. So 85% of their business is done with their core designs and their core fabric, which is Fion X, and their core colors, of which this entire inventory increase pretty much contains. So they're not seasonal designs, and they're not expected to be problematic. And so they are planning to shift their purchasing practice in accordance. So when we see that high increase in inventory there and it's slowing down in turnover, we know that it's stuff that they are confident they can move and sell. So not very concerning. And of course, it also means that they're bringing in more of what they need to sell. And they're not going to end up in a situation where they've got stuff they can't move, but also they're not going to end up in a situation where, say, supply chain freezes up again. I mean, just a couple weeks ago, UPS was looking at striking, and so that would really put a damper on things. But definitely a situation where they've got plenty on hand and they're going to be able to move it. They currently recognize 2.3 million active subscribers. They have a net revenue of 221 per those repeat customers per year. So I apologize. Those active subscribers are primarily repeat customers, and that's what you want to see. So they have people that are coming back over and over and over again. And again, non-discretionary item. They need these things, but also they want to look good on their job, right? And of course, they're transitioning. So this is one of the challenges for them. They're transitioning from being classified as an emerging growth company, which they got that status at IPO. And they're going to have to change their filing to a large accelerated filer. And of course, that's going to change the regulations on them and the regulations for their reporting. So something to keep an eye out to see what kind of changes we notice in what they're reporting as that takes place, because that'll give us a little more in-depth information about the company. Of course, they have a strong brand awareness, but they also have the danger of imitation. With something as simple as a better fabric, something as simple as better cuts and designs, sometimes those can be easily replicated. So that's a big danger for a company like this. They have to watch out for that, and hopefully they can navigate that well in order to retain their competitive advantage in that market. So again, something to watch out for. But again, you have companies like Uber. I did a video on that a little while back, and they've got a lot of competition, tons of competition in every single one of their business segments. However, especially in the ride sharing segment, there's people like Lyft, big, huge company as well. But when you think about getting a ride share, you think of the name Uber. You don't think Lyft so much. And so they become synonymous. That's a strong competitive advantage. And I think FIGS is definitely on the right track to attain that. And then in terms of critical audit matters, really just internal controls over reporting of revenue, internal controls over reporting of inventory. They were both just raised due to them relying on third-party systems. So not majorly concerning there. So definitely a interesting company, one to watch here in the near future. If it's one you're watching, I'd love to hear your thoughts. If you have questions, comments, concerns, definitely drop those in the comment section. As always, like and subscribe. Definitely a shorter video for me, but definitely interested to see where this company goes. Big decrease in price, obviously, but that's normal for newly IPO'd companies over the first few years. So if they can sustain it, keep growing those revenues, I think there's a big value investment opportunity here. But again, I'm not trying to give out investment advice. Do your own research. And of course, dig in, invest well. And I hope to see you next time. Again, like, subscribe, comment, give me some feedback. And I definitely will incorporate that moving forward. And of course, if you have